December 2nd, 2001. The phones won't stop ringing. Inside Enron's headquarters in Houston, executives scramble behind closed doors. Lawyers move through hallways carrying stacks of documents. Employees gather in small groups, whispering questions nobody can answer. The seventh largest company in America is collapsing in real time. Not years, not months, days. The company once worth more than $60 billion is filing for bankruptcy. Thousands of employees are about to lose their jobs. Many are about to lose their retirement savings too. Outside, reporters crowd the building. Inside, panic spreads floor by floor. One employee later said it felt like a funeral nobody planned for. Because just months earlier, Enron wasn't a failure. It was America's future. But to understand how we got here, we need to go back to 1985. That year, two energy companies merged to create a new business called Enron. At the center of it all was Kenneth Lay, a charismatic executive with a simple vision. America's energy industry was changing, and Lay believed Enron could become the company that connected everything. At first, the business wasn't glamorous. It owned pipelines. It transported natural gas, steady, predictable, boring. But Kenneth Lay saw something bigger. As energy markets began opening up, he imagined a future where energy could be bought and sold almost like stocks on Wall Street. Instead of simply moving gas through pipelines, Enron would become a marketplace. A middleman, a giant trading machine. And for a while, that vision looked brilliant. In the 1990s, America was obsessed with innovation. The internet was exploding. Technology stocks were soaring. Investors wanted growth. And Enron knew exactly how to tell a growth story. Then came Jeffrey Skilling. Brilliant, confident, sometimes intimidating. Skilling believed Enron wasn't really an energy company. It was an information company. A company that could trade energy, predict demand, and profit from market movements. It sounded revolutionary, and investors loved it. Year after year, Enron reported growth. Its stock price climbed. Analysts praised the company. Business schools studied it. Television hosts celebrated it. Wall Street couldn't get enough. Then came the awards. Fortune magazine named Enron America's most innovative company. Not once. Not twice. 6 years in a row. That title became part of Enron's identity. People stopped asking whether the company was successful. They assumed it was. The company expanded everywhere. Energy trading, broadband networks, water projects, international ventures, new markets, new promises, new opportunities. Every year, the story got bigger. And every year, investors bought in. Inside Enron, success became a culture. Employees were pushed to think bigger, move faster, take more risks. Winning was rewarded. Questioning was not. The stock price became the scoreboard. As long as it kept rising, everything appeared fine. By August of 2000, Enron stock approached $90 per share. Retirement accounts swelled. Executives became celebrities. Employees felt lucky just to work there. To the outside world, Enron looked unstoppable. But beneath the surface, something dangerous was happening. The company was becoming harder and harder to understand. Investors struggled to explain exactly how Enron made money. Analysts asked questions, then accepted vague answers, because the numbers kept looking good. And when people are making money, they often stop looking for problems. That was the trap. The more complicated Enron became, the more impressive it appeared. Complexity started looking like genius, and almost nobody realized the difference. Behind the scenes, cracks were already forming. The company wasn't just making money. It was creating the appearance of making money. One of the most controversial tools was aggressive accounting. Under Jeffrey Skilling's approach, Enron could estimate profits expected years into the future and record them immediately. A project that might earn money over a decade could suddenly make today's earnings look stronger. On paper, profits appeared. In reality, the cash often hadn't arrived. Then there were the special purpose entities. Small partnerships created outside Enron's main books. Many were designed by Chief Financial Officer Andrew Fastow. At one point, Enron had over 3,000 of these entities. Losses became harder to find. Financial statements looked healthier than they really were. To many investors, the numbers still appeared impressive. But the reality underneath was growing weaker. A few people inside the company saw the danger. One of them was Vice President Sharon Watkins. In August 2001, she sent a warning directly to Kenneth Lay. Her message was clear. The accounting practices could destroy the company. Enron, she feared, could implode. But by then, the machine was already moving too fast. Executives had spent years building a story. Wall Street believed it. Employees believed it. The media believed it. And when an entire system wants to believe something, warnings become easy to ignore. The collapse wasn't coming because nobody saw the signs. The collapse was coming because too few people wanted to act on them. Then everything started falling apart. August 2001. Jeffrey Skilling suddenly resigns as CEO. The announcement shocks investors. Official explanations are vague. Personal reasons. A desire to spend more time with family. But on Wall Street, alarm bells begin ringing. Why would the architect of Enron's success walk away now? Confidence starts fading. Questions become louder. Analysts dig deeper. Journalists investigate. Investors begin looking beneath the surface. And what they find is troubling. In October, Enron announces major losses. Then comes an even bigger revelation. The company must reduce shareholder equity by more than $1 billion. Soon after, the Securities and Exchange Commission opens an investigation. The market reacts instantly. Trust begins evaporating. For years, Enron had sold investors a story of endless growth. Now that story is falling apart. One headline at a time. One disclosure at a time. One shocking discovery at a time. The stock keeps falling. $70, $50, $20, $10, $5. Every drop creates more panic. Every drop creates more selling. Employees watch helplessly. Many have retirement accounts heavily invested in Enron stock. Their future is disappearing alongside the share price. Some lose decades of savings. Others lose almost everything. And there is nothing they can do. The company they trusted is collapsing beneath them. In November, Enron tries to save itself. A merger with rival energy company Dynegy is proposed. For a moment, hope returns. Maybe the company can survive. Maybe disaster can still be avoided. Then the deal falls apart. That was the end. Without trust, Enron had no future. Without investors, it had no lifeline. Without credibility, it had no business. On December 2, 2001, Enron files for Chapter 11 bankruptcy protection. More than 20,000 employees are affected. Billions of dollars vanish. One of America's most celebrated companies becomes one of its greatest corporate failures. And almost overnight, the illusion is gone. More than 2 decades later, Enron still matters. Not because it was an energy company, because it revealed something timeless about business. People often assume that successful companies are easy to recognize. Enron proved the opposite. Sometimes the most dangerous companies look like the safest. They win awards. They dominate headlines. They attract brilliant employees. They convince everyone they are changing the world. For investors, the lesson is simple. If you can't clearly explain how a company makes money, that's a warning sign. Complexity is not always intelligence. Sometimes it's camouflage. For employees, Enron is a reminder that loyalty to a company should never replace financial diversification. A paycheck and a retirement account tied to the same company can become a devastating combination. Enron didn't collapse because people were stupid. It collapsed because people were comfortable. And comfort is the most expensive thing you can afford on Wall Street. A reputation can take decades to build and days to destroy, because eventually, every company faces the same test. Not whether it can tell a great story, but whether the story is true.